All right, so today we're going to be talking about investments, and so we'll do a little bit of background on some of the fundamentals, different asset classes, talk about the idea of diversification. I guess we've got this on an agenda here. Suzanne talked a lot about investment policy, so we'll talk about some of the other things there, maybe in a different perspective from what Suzanne talked about. The idea of diversification and asset allocation. So the idea of not putting all your eggs in one basket. There's a lot of uncertainty out there in the world right now. So just the idea of trying to spread the risks over many different factors. So if one thing happens, it's not going to impact the entire portfolio. And then asset allocation. So things like how do we decide how much of which category and what categories to choose from, things like that. So the asset classes, we'll talk about some of the traditional, so stocks and bonds are what generally people are more familiar with, and then some of the alternatives that Suzanne mentioned as well. So things like real estate and infrastructure and a few others. And then investment monitoring was another topic that Suzanne mentioned, and so we'll talk a little bit about that, what kind of things to look for, frequency, compliance, other things like that. And then we could we'll see how things are going, but we could take a little break in between part one and part two if people are feeling like they need to get out there. So part two, we'll do a group exercise, and I think it makes sense just to work with the people at your table. We've got a few questions to work through. So that'll be the second part of today's session. And if there are any questions, I'll try to pause throughout, but feel free if anybody does have any questions at any point. I think Molly's got a microphone and she'll go around, but feel free to just jump in at any point here. So where do investments fit in here? So the role of investments typically within Indigenous trusts, I think a lot of people would be representing here today, but there are a few other organizations. I know Gordon and Emily are here from the First Peoples Cultural Foundation, so that there are other organizations here that are investing money, but for by and large, a lot of the representation here is on behalf of your communities. So the different beneficiaries, so making sure that you're taking responsibility, investing the funds in a prudent way, whether that's come from settlements or impact benefit agreements. There's lots of different ways that the money could have arrived, but the idea of just taking the responsibility, setting up a good investment structure, and making sure that you're bringing that financial benefit for the community, whether that's through annual distributions or minors payments. There's many different ways that you could be providing that benefit, but the general idea is investing the money so that it can grow over time, as well as provide cash flow payments to help your communities out. So Suzanne did talk about the investment policy. There's many different names that it can go by. IPS, so Investment Policy Statement, or Statement of Investment Policies and Procedures is another one. SIP and G sometimes, so Statement of Investment Policies and Goals. It's all kind of the same thing, where it's just the governing document that's essentially the rule book for how are the investments for your fund meant to be managed. And so this is a document, it's a living document. It's not something that's just done once and left forever. It should be revisited regularly, reviewed at least on an annual basis. Sometimes those reviews are just going to be, yep, everything still makes sense, whereas other times, depending on what's happening in the community or changes in the investment environment, there could be more significant changes that happen. So looking at things that should be showing up in the investment policy. So the overview of the fund's purpose and goals. So what are you trying to accomplish with these? In some cases, it could be exclusively for miners. Maybe it was a portion of a settlement that's been set aside as an investment, and the only objective there is to provide an inflation-based return, or it could be a set percentage, so that every year when the miners get older, the values that they'd be receiving as a payout could be increasing. It could be tied to annual disbursements to the communities, which again could be linked to inflation, or in some cases it could just be, the funds are set here for a short term. There's going to be a big real estate development in 2 or 3 years, something like that. And so that could have a very different time horizon for the investments. Roles and responsibilities. So lots of different parties are involved. So typically the trustees would be, whether that's community trustees or administrative or corporate trustees. So defining who are the trustees, where does the fiduciary responsibility lie? Investment managers, so the companies that would be hired to manage the money, so that they'd be running strategies, could be stocks or bonds or real estate or infrastructure. So making clear, who's involved and what they're supposed to be doing. A custodian is another organization that might show up here. So the custodian would be the organization that holds the assets. Sometimes if they're invested through pooled funds, it's the fund manager would have a custodian that would take care of holding the assets at the underlying fund level. And then so the custodian for the fund or the trust or the foundation, it's more of a record-keeping exercise there. So that you just want to make sure that you're clear in the investment policy, who's doing what. Investment consultant could be another role that's included. So they're the ones providing the oversight, the advice for potential changes to the composition of the fund, both at a type of investment and the investment managers who are hired. Auditors sometimes referenced in there. So you just want to make sure that every different group who's involved with the investment fund, it's documented in the policy what their role and what their responsibilities are. Investment objectives and risk tolerance. So this would be one where we'd look at benchmarks both at the overall fund level and for each of the underlying strategies. So for a lot of the overall funds, you might have an objective, something like inflation plus 3%. So you want to maintain your purchasing power, which just means as things get more expensive every year, you want to make sure that you're at least keeping up with that. That would be the inflation part. And then you might want to earn, or likely would want to earn, a premium on top of that. So whether that means the disbursements that you're sending to the community every year, you want to earn that on top of the inflation, or covering other cash flow needs. So there typically would be some kind of link to what the purpose of the funds are to what your objective is. If all you need to do is maintain inflation for the purpose of miners' payments, you would not want to be looking at a fund that's looking at double-digit returns, taking on a tremendous amount of risk, because you would not want to be in a situation where you catch a downturn. You've taken a risky approach. The values are down by 20% with a stock market crash, and all you really needed to do was earn 2% in inflation. So making sure that there's good alignment with what the purpose of the funds are and the risk tolerance that you're looking for. So you'd want to make sure that you're looking at that at the overall fund level, but also for each of the underlying components. So Suzanne talked about passive strategies that are available for stocks and bonds. So there is an option to invest in either an ETF or an exchange traded fund, or other passive funds where they're very inexpensive. And the goal of that is to return exactly what the market's doing. So nobody's there trying to pick the best companies to invest in. All they're doing is saying, okay, we just want to give our clients the exposure of what the market is right now. And so that would be an option for investors. And so you want to compare how the active managers are doing. Active just meaning they're the ones that are trying to pick the best companies to outperform these benchmarks, and finding out or determining or writing down there what would be an appropriate benchmark. So for somebody who's investing in real estate, measuring that against the TSX, the Toronto Stock Exchange, not the best comparison. Because there are real estate measures out there. Maybe you want to link inflation to it, something like that. So just making sure that there's a good alignment between what the managers are investing in and what the benchmark comparison is. And so in addition to something like inflation plus 3.5, or whatever it is at the total fund level, we would also want to be looking at the kind of the weighted average of the benchmark, the underlying strategy for the market benchmarks, to compare the total fund to that as well. And making very clear whether this is on a gross of fee or net of fee basis. And typically, we'd be comparing it on a net of fee basis, because at the end of the day, those are the monies that are there left to provide the benefits for the community. So if a fund manager is earning 10%, that's great. But if they're taking a big chunk of that, if it's a 1.5% fee or something, you care more about the 8.5% that's left, not what they're earning before fees. So it's very important to be as clear as you can in the investment policy document. Risk tolerance is another one. So one of the big factors there is the time horizon. So if this is a perpetual investment that's meant to provide for current and future generations, there's a long time horizon there. So there is an ability to take on a little bit more risk if it is appropriate based on what the fund's purpose is. Whereas something that's there for the very short term, that's really just meant to earn a little bit, so that a little more than what it could be doing in a bank account, something like that, could come up with a very different investment strategy. So it's very clear that you want to incorporate the risk tolerance and time horizon into this document as well. Asset mix is another very important part to the document, and that's where it outlines what types of investments are allowed to be in there, and how much of each. So you might think of things like Canadian stocks or global stocks or Canadian bonds or real estate, things like that. So you want to have it very clear in your policy to say, okay, we've got a target weight of 20% in Canadian stocks, 30% in global stocks, whatever the numbers may be, maybe 10% in real estate, 20% infrastructure, whatever the numbers are. You want to make sure you've outlined that in your policy. And not only do we specify what the targets are, but we want to say how much is it allowed to drift. Because investments are not always going to earn the same amount. There are some periods where like over the last couple of years, stock markets have had tremendously high returns. And so, maybe if you started with 20% in stocks after the last couple of years, maybe that's come up to 26% as a relative weight in the portfolio. And so inside of this document, you'd want to put the allowable ranges that say, okay, we would allow stocks to go up to 30%, but if we would need to rebalance before it goes out. We're not just going to let it drift up to 50%, for example. So we want to be very clear that there are minimums and maximums in there, as well as what the targets are for each category. Investment restrictions or permitted investments would be another one. So there might be some investors that don't want to invest in fossil fuels, as an example. And so the investment policy would be very clear there to provide the instruction to the manager to say, and it wouldn't just say fossil fuels. There would be a proper definition, companies that earn a certain percentage of revenue from production or refinement of oil and gas, things like that, where you just want to be very clear in the policy to say, these are not permitted in the portfolio. In terms of types of investments as well, there could be, if the trust agreement or something says that your categories are not allowed. So private equity maybe for whatever reason, the trust agreement says that that's not allowed, that would not be listed under the permitted investments within the investment policy statement. So it's just saying what's allowed, and then even within each of those categories, so for stocks, maybe instead of fossil fuels, you want other parameters in there that say we're not allowing more than 10% of the stock mandate to be in any one company. Or for bonds, you've got to meet a minimum credit rating. You can't just invest in high yield bonds, things like that. Certain percentages, a max of 50% in a province, things like that, where you're just outlining, essentially what's allowed to be in the portfolio. Because this document is really, it's the rule book or the instruction guide that's provided to the managers that say, okay, here's how we've documented how we want our policy or how we want our investment fund to be managed. So that's why it's very important to be as clear as you can in terms of what shows up in that document. Other considerations in there, so liquidity. So liquidity means how quickly you can convert your investment into cash, both going into and out of the fund. So things like real estate and infrastructure would not be very liquid. It could take months or potentially even a year or multiple years to get that investment out. Whereas something like stocks and bonds, you could request that and within about a week's notice, you'd be able to get that out as cash. So lending, maybe there are provisions where the trust is allowed to make a loan to the community, or maybe that's not permitted. And so you just would need to be very clear there. Voting rights. So in the case of using an investment manager, there could be proxy voting guidelines. So for all of the stocks that you own, every year there'd be resolutions for that company in terms of how to vote. Some things would be on the management structure, so the board structure, who's sitting on there. Some things are like which auditor to hire, but there could be other more significant votes that would come to the shareholders and share as an organization. I know one of the big things that they do are advocating on behalf of their clients and putting forward new resolutions. So the voting rights and proxy voting guidelines, things like that, would be something else that you may want to reference in the document. How the investments are valued. So for some things like stocks and bonds, where there's an open market, it's very easy to get the value for that. Other things like real estate or infrastructure, it's not as obvious, so often there'd be a third-party appraisal involved, and so just saying what the process is to determine what the market value for these investments are. Related party transactions and conflicts of interest would be another one that would show up here. So just being very clear about all of the policies around the investments, making sure that you've got them all documented in the policy here, because when you're looking at an investment fund, whether it's just starting out from a new settlement or revisiting over time, you're really thinking out of a long-term plan and building your ship. So you want to be thinking about all of these things ahead of time, so that if there's a significant market event that happens, you don't want to be forced to come up with an idea or panicking at the time. Suzanne's example about moving half of it to cash when it's already dropped by 40%. You want to outline what your process would be for something like that in the policy ahead of time. When you have the time to think about it, you're not being forced to react, so that when those events do happen, you can refer to your policy or your rule book, essentially, that says, okay, we've thought about this already. Here's the process that we decided we were going to follow, so that we don't need to react and panic in the event of a downturn. So in terms of deciding what the risk tolerance should be, so things like liquidity. So if you know that there's a chance that your community could draw on the fund within a 3 months notice, something like that, that would be a key factor. So you'd want to make sure, are there provisions where there's a chance the majority of the portfolio could be withdrawn in a few months? That's going to be a very different structure than if you're investing in the long term, there may be provisions about capital encroachment, and you wouldn't be allowed to disperse more than, say, 3% a year. So in that case, you would have a high tolerance for liquidity, whereas in the former case, there wouldn't really be much ability to take on illiquidity, and you'd need everything to be accessible on short notice. Income needs. So are you distributing on a regular basis, either through minors payments or annual disbursements? Is that a key component of the fund, or is this something where you're just investing for the long term? We're going to put it away for 10 years. We're not going to touch it. We want it to grow to a certain scale. And then once it reaches a certain threshold, then we'll start taking funds off of that so that they'll be more significant for the community. Time horizon, we talked about that already. Adherence to the trust agreement or the trust deed. So it's very important that your investment policy is aligned with that trust deed. We've seen some situations where the trust deed only allows investments eligible for an RSP, for example. We would not suggest that wording in there, but we have seen some examples where something like that shows up. And so we make sure that the investment policy is going to adhere to that, even if it may not be the most preferred process. You can't just go against the trust agreement because you don't agree with it. ESG considerations would be another topic that you'd look at, both from a risk tolerance and want to incorporate that into the policy as well. And I know there's a talk this afternoon on responsible investing and ESG as well. So any other questions on the investment policy statement before we move on to the next section? Yeah, Cora.
What is ESG?
Oh, what is ESG? So ESG stands for Environmental, Social, and Governance. And it's a topic that's really grown, I would say, in interest over the last decade or so. It's a big part of the work that SHARE does as an organization. And it's looking at things like, so environmental would be things like climate change. So wanting to make sure that you're investing sustainably and promoting positive factors in the world. Social would be things like the impact on communities, whether that would be consent from indigenous communities, if that's where the project is, or on a more global basis, looking at making sure you're not investing in things where they're using sweatshops or they're taking advantage of communities, kind of moving in, taking all the resources away, leaving the community worse off than they found it, and moving on to the next area to do the same thing. So making sure that there's a good social impact as well. And then governance would be things like at the board level, making sure that there's good representation from different groups, and just in terms of how the investments are or how the companies you're investing in are broadly managed. And I'm sure that this will come up in more detail at this afternoon's session on responsible investing. But good question. All right, so moving on to the next section. So here we're going to talk about diversification. And I've got a little example. So as I mentioned, I grew up in Ontario. I had an aunt and uncle who had a cottage out in the Minden area. And my aunt, Aunt Susie, she had a little shop at the beach there. And she had the cottage, wanted to open up a little business there. And so she started selling sunscreen. And on sunny days in the summertime, it was great. People would come by at the beginning of the summer, buy their sunscreen. But then on the rainy days, nobody would show up. Her business essentially might not even be there when it rains. And so she thought it would be a good idea to start selling umbrellas there. And so she's got the two different products. She's got the sunscreen for the sunny days, umbrellas for the rainy days. Great. Whatever the weather is, there's going to be some customers there. But as the summer progressed, people already had their sunscreen. They already had their umbrella. So there were no repeat customers. They'd come once and they'd be set for the rest of the year. So she thought she might start selling some drinks and treats. So open up a little drink stand or an ice cream stand. And again, on those sunny days, people want cold drinks or a nice ice cream cone, something like that. They'd come by. But then again, on the cool days, she wouldn't really be having that business. And so she's expanded that by starting selling coffees and muffins and everything. So she's got all the different types covered, whether it's sunny or rainy or beginning of the season or later in the season. Got lots of different products there to cover whatever people are looking for. And so the idea here is around diversification. So initially, when all she sold was sunscreen, she was very reliant on both sunny days and the beginning of the year, beginning of the season. And so, if it was a rainy day or people had already purchased the sunscreen, she wouldn't be generating any money for her business. And so she's expanded into different categories here. And so this idea is diversification. You don't want to only be exposed to one type of investment or one factor where if things go the other way, your entire portfolio is hooped. And so that's just a little example to talk about the idea of what diversification means. So essentially not putting all your eggs in one basket here. And so this shows up in terms of the investment portfolio when you're looking at different asset classes, so different types of investments. So you would not want to invest, certainly not all in one stock. If you put all of the money in one company, that's extremely risky. Something happens with that company, then all your money is gone. I mean, maybe it could double if something really good happens, but more often than not, you worry more about the downside, what could go wrong, and so you definitely not want to invest in one company. Same idea applies for one asset class. So investing only in Canadian stocks, yeah, I mean, it's a bit more diversified than one company, but there could still be a significant impact. Tariffs could impact the entire Canadian stock market or a big part of the Canadian stock market. So you want to diversify into other types of investments, both geographically, so Canadian stocks, global stocks, whether that's US or international or other parts of the world, but both geographically and types of investments. So looking at other things like bonds or other types of loans or real estate or infrastructure and mortgages, things like that. And so we've got, the asset allocation. There are studies that show that is the key determinant in looking at a portfolio's level of risk is how well the assets are diversified and what that asset mix is. And there's no one solution that fits everybody. It depends very much on what your community's needs and objectives are, what the permitted investments, what the philosophy is, whether that's industry benefit agreements or exclusions to certain types of investments. So there is no one solution. That's why it's very important as a group to work with your community, with your trustees, to decide, what are we looking for and how can we meet that goal and what is the appropriate asset mix to get there. And when we talk about an asset class, we're really talking about a category of investment. So Canadian stocks would be an example of an asset class. And each asset class differs very much in what the risks and the expected return profile is. So we've got on the left side here traditional asset classes. So this would be things like stocks and bonds. So within bonds, we'll talk a bit more in the next few slides, but you're essentially lending to a government or a corporation or other organization and just getting that interest payment and then your principal back. Equities, that's when you buy a piece of a company through stock. And then we're seeing more and more in the alternative space or the private market. So things like commercial real estate or mortgages, infrastructure, private equity. So similar to stocks, except these would not be traded over a public exchange. These would be private investments in companies. And then private debt or direct lending as well. Similar idea, except instead of owning the company, you'd be lending. And I think there's later, not today, but later in the conference, there is a specific session just on private debt. So that'll be interesting there. So just a little more detail on some of these asset classes we talked about. So bonds is the first one, and bonds is you're just lending money to an organization. So whether it's a government or a corporation, they'd be looking to raise money for a different project that they have, or if it's a government, they've got to provide public services, things like that. And so the basic idea that a bond works is, somebody might issue a bond, whether it's province of BC or, Canadian Tire, different company, something like that. So they would say, okay, we're going to issue a bond. So we're looking for somebody to lend us. The example we've got here is $1 million. So if you lend us $1 million, we're going to use that to come up with a new business line or fund a water treatment facility, something like that the government might do. And by lending us this money, we are going to pay you back with interest over the next 10-year, might be an example period, could be longer, could be shorter than that, and maybe twice a year. So the example we've got here is twice a year, they're going to pay you $12,500. So per year, it would be 2.5% that the investor. So the investor here is the person who's or the group that's purchasing the bond, who's lending the money. So they're making money by getting those interest payments. In this case, it would be twice a year. There could be other arrangements. And then at the end of the period, they get their full $1 million back. So these are typically relatively conservative when you think about holding it to maturity. And it's, as long as it's a reliable organization that you're lending to, there's a good chance that you're going to get your money back. There are some cases where there would be more risk and you need to be compensated. You need to earn a higher rate of return because there could be a greater chance that you might not get your money back. But if it's something like Government of Canada, it's quite reliable and it would be a relatively low risk investment when you're holding it to maturity. If we look at what the value of bonds are on a day-to-day basis, it can actually fluctuate a fair bit. So in the example here, the bond was issued at 2.5%. But if interest rates change pretty significantly, then that can have a big impact on what the bond is worth. Like say if you needed your money and you wanted to sell it to somebody else, what are they willing to pay for it? And that can have a significant impact when interest rates change a fair bit. But essentially, you can think of a bond as a loan to an organization where you're just getting fixed interest rate payments back. And if interest rates go up or down, you're still committed to what that original contract or that original agreement was at the time. So why would you want to invest in bonds? So capital preservation. So like I said, when you're holding it to maturity, it's usually relatively safe. You can consider it risk-free if you're looking at a federal government. Often in the investment world, we talk about risk-free investments. And so that would usually be a treasury bill, something like that. Generally less volatile than stocks. Good diversification. So in situations where stock markets fall, bonds, not always the case, but bonds may move the opposite direction or vice versa. Liquidity. So for public bonds, very easy, very quick to convert those to cash if you need it. So this wouldn't be something that's locked up for a long period of time. And the income stream that it provides. So those regular interest payments that are coming in, if you need to make, minors payments or even just covering expenses, it's good to get those regular cash flow payments. You're not locking things up for 10 years and never seeing it again. So what are the risks? So credit risk. So this would generally show up more in investing in companies rather than governments. But credit risk or default risk is how likely are you to get paid back? And for organizations like the Government of Canada or Province of BC, there's a very, very good chance that you're going to get your money back. And so they would be reliable. You wouldn't generally earn as much return because you're not taking on as much risk. Whereas different countries around the world, there could be more risks, like investing in Argentina, for example, or investing in smaller companies through bonds. There's more risk there, and so you'd expect to get a higher rate of return, because if you're going to get the same return to invest in Argentina versus Canada, it's much safer to invest in Canada, so why would somebody invest in something more risky? And the way that we measure credit risk with bonds is looking at these rating agencies, and they typically use a scale that looks like this. So the safest would be AAA, and go down AA, single A, all the way down to C. And so the cutoff for investment grade versus high yield bonds would be between that BB and BBB. That doesn't mean high yield bonds are, you're throwing your money away. There's still a very good chance you're going to get paid back. But, depending on where it sits on this spectrum, you could earn a higher rate of return, knowing that there is a greater chance that there could be a default, or you may not get all your money back. If a company goes bankrupt, the people or the organizations that are lending money rather than buying the stock, they would be the ones to get paid back first as well. So even if you lend to an organization that goes bankrupt, again, we would generally not encourage too many risky or any risky loans, but there is some comfort knowing that as the lender for the debt, you would be paid back before people who own shares in the company would be. Those would be the equity holders, and they would be, if there's any money left after paying all the bondholders, then they would get some in the case of a bankruptcy. So another risk that would apply for bonds would be the interest rate risk. And I touched on this earlier in terms of when interest rates are moving up or down, that's going to impact what the price of the bond is in terms of when somebody's going to buy it from you. If you're just buying it, putting it away, holding it to maturity, there could be fluctuations in terms of what it's worth at that given time. But you're like when you own the bond, you own that cash flow stream. So whether it's the 1.25% interest payments twice a year, and then the principal at the end. So if you hear about market interest rates, if it's gone up or gone down, you're still getting that same $12,000 twice a year, and then the $1 million back at the end. But what is different is how much somebody would be willing to pay for that cash flow stream or for that bond that's already in existence. And if interest rates go up, then people are going to say, well, I'm not going to pay you $1 million for a bond that's only paying 2.5%. I want to purchase that at a discount. I could go buy a new bond that's going to pay me $50,000 a year. So why would I pay you $1 million for something that's going to give me a lower return? And so that's the idea of duration. And so duration is something that measures how sensitive the price of a bond is to changes in interest rates. So as interest rates go up, so in the example, if we went from 2.5% to 5%, that's a big jump in interest rates. And so the value of the bond that was already out there, somebody already owned it, that's going to drop pretty significantly in value because people aren't going to be willing to pay $1 million. Maybe they're only going to pay $900,000 for it, or it depends how long until the bond matures, but they may only be willing to pay a 10% discount to the price of the bond. And the opposite is true as well. So if interest rates come down, so instead of going from 2%, if we drop down to 1%, if you hold a bond that's paying $25,000 a year, and somebody else is going to go out and buy one, and they're only going to get $10,000 a year, they're going to pay you a premium for that. Instead of being worth $1 million, maybe now that's worth $1.1 million. Someone's going to pay extra because that cash flow stream is more than what the market is willing to provide now. So the general idea, it's kind of confusing because you think, well, interest rates go up, I'm going to earn more on the bonds, and that's true. but the value of the bonds that are already out there would move the opposite direction. So interest rates go up, like we saw in 2022. So interest rates came up significantly a couple years ago. Bonds went down by over 10% on average. So that it can have a very significant impact. So if you're looking at what bonds are worth today, not just holding it to maturity, it can have a pretty significant impact the way interest rates move up or down. And depending on how long the term is on the bond, it's going to be more or less sensitive. So a bond that's got another 30 years of those payments, it's going to be much more sensitive to those changes in interest rates than a bond that's going to mature next year and there's only one more interest payment. Interest rates are very difficult to predict. They can be subject to many different factors. So inflation is one of the key drivers for what interest rates are. So we've got a chart here that goes back to 1992, and you can see, and these were the Bank of Canada overnight policy. So typically bond yields or the return, the interest rate you earn on bonds would be much higher than this. But this is the overnight lending rate that the Bank of Canada, you hear about the updates every couple months where the Bank of Canada has increased or decreased by 0.25%. This chart shows what's happened over the last couple decades here, and you can see there it has been quite volatile. The general trend is it's come down pretty significantly, but there's, it's quite a roller coaster of going down and up, up, down, up, down. So even though bonds are generally thought of as more conservative than the stock market, there still can be lots of market events that would impact the price or the market value of a bond at a given time. So the next one we've got on the list here is public equities, and so these are stocks. So you think about owning shares of companies that are traded on the TSX or the New York Stock Exchange or different exchanges around the world. And here you're owning a piece of the business for better or for worse. You would only buy a business if you think that it's going to provide a positive investment return. And there's a couple different ways that you can earn money by investing in companies. One is just the share price goes up. So if you buy at $100 a share, the company comes up with a new product that's very successful. Maybe next year it's worth $120 per share. So just by the value of that, your investment's gone up by 20%. There's another way that you can earn money on stocks, and that's through dividends. So just by owning a piece of the company, they may pay, 5 cents a share or something like that, where, it could be as high as 10%. That's more often than not, it's kind of on average, in the 2 to 3% range that a company might pay for dividends. But just by owning the stock, every year they'll give you a cash payment. You could either reinvest it or take it out as cash. Just by owning that stock. So the two main sources of earnings with owning stocks are through the capital appreciation or the share price going up, and then the other would be through the dividend yield or the income that they're paying you just by owning those shares. Voting privileges is another important factor of owning a company that would not apply on the bond side or on the debt side, where as an owner of the stocks, you're entitled to vote on the different resolutions that may be presented to the different shareholders. And there's lots of things that can impact the price of a stock. Seems more and more there's uncertain events. Somebody tweets something, or tariffs have had a big impact on stocks, or geopolitics, what's happening in the Middle East, what's happening in Ukraine. That had a very significant impact on the stock market. So there could be factors that have nothing to do with the company itself, but just uncertainty around the world is what's causing the values of stocks to go up or down. And so stocks are generally a relatively risky asset compared to bonds and some of the alternatives we'll talk about. So characteristics of a stock would be the size or the value of the company itself. And so the term that we use here is market cap or market capitalization. And it's really just, how many shares are out there times the price of the share. So what is it worth? You can group types of investments in stocks based on the size. So you might hear small cap or large cap or mega cap in some cases. That just means how big is the company. The general trend is that larger companies would have less risk than smaller companies. That's not always the case, but generally speaking, small cap would have a bit more risk, and you'd expect to earn a bit more than large cap companies. You can also look at different sectors or industries as a more detailed breakdown. Energy companies or financials or IT or utilities or real estate. There's lots of different ways that you can break apart different types of organizations. Geographies as well. So we talked about this a bit earlier. So whether you're just investing in Canadian stocks or more globally, Europe or the United States or emerging markets, companies where there's more risk, but you'd expect over the long run to earn more return as well. So lots of different ways of breaking up the equity space. So why would you want to invest in equities? There's a lot more risk there than there is in the bond market. And the reason is that you'd expect to earn a higher rate of return. Over the last couple of years, we've seen 20 to 30% increases in the stock market, which is very good. Anybody that's been invested for that time, they've earned a lot of money there. But there's a lot of risk. If we look at the beginning of 2020 when COVID first hit, or even during 2022, there were periods where stocks were down 20 to 30%. Back in 2008, great financial crisis, or the global financial crisis, there were significant drops. Some companies went bankrupt altogether. Others were down, 30, 40, 50%. So certainly over the short term, there is a lot of risk there. But generally speaking, over the long term, you would be expected to earn more than you would from bonds. Also a good diversification relative to bonds, in cases where stocks might go up when bonds are going down if you're seeing higher interest rates. So it's a good diversifier in that way. And it does give you the ability to, depending on your size and other organizations you may be aligned with, it does provide more ability to have an impact on the governance when you own a piece of the company versus just lending money with the bonds. So lots of different risks there. So the company risk, we've talked about some of these already, where some of these could be tied to the company specifically, whether it's a new product that is either successful or not, or new management that comes in, maybe they've got a new CEO, new product, something like that, where it could very much have an impact on the company. There are other things like the tariffs or other geopolitical or economic factors that can have an impact, or where we are in the economic cycle. That can have an impact on the company as well. So there are a lot of risks out there for investing in stocks. And so outside of stocks and bonds, what else is there? For a lot of retail investors or people that just invest their own money, not through an organization like a trust or a foundation, a lot of the time, these are the main things that you'd be eligible for. Putting something in your RSP would typically be in the stock and the bond space. But for organizations like yourselves, where there is more ability to invest in private markets, then we would look at the alternative space. And the main difference in the alternatives versus the traditional that we just talked about is the liquidity, or the ability to get into or out of these investments on a relatively short time frame. Another benefit would be the low correlation. So whatever's happening in the stock market or with interest rates, with bonds, some of these alternatives like infrastructure could be investing in hospitals or water treatment facilities or renewable energy, or availability-based infrastructure like a toll road, where all you need to do is provide a road for cars to drive on, and a provincial government would be paying you a revenue. Low correlation to other assets. So it's generally pretty stable regardless of what's happening in the rest of the world. It's going to earn a pretty stable, strong investment return. A lot of these can provide inflation protection as well. So there's some cases where it could either be implicitly or explicitly factoring in inflation. So maybe for renewable energy, there could be an agreement with a crown corporation like BC Hydro, where as inflation goes up, the investors in these solar or wind farms are going to have revenues that are tied to inflation as well. Real estate would be another one, where the value of the property would tend to move with inflation as well. So if your underlying goal for the fund and for the community is to have a connection with inflation, then a lot of these alternative assets may provide a better alignment than some of the traditional public options. Often for investors, they'd be, and this would actually go the same for stocks and bonds as well, would be investing through pooled funds that have exposure to lots of different investments. So for investors, huge investors, that are tens of billions, they can come up with their own portfolio. They've got the structure. They can buy their own real estate or infrastructure assets. But for many of the trusts that are, under 5 billion or certainly under 100 million, looking for a strategy that's already got good diversification through a pooled fund rather than trying to buy these, buildings or whatever individually is a much better way to go to get that diversification. There's something called a closed-ended fund, which is where you say, okay, I'm going to commit my, $5 million, whatever it is. The manager is going to take that. They're going to find things to invest in. There may be some distributions, and then 10 years later, they're going to give all the money back to the investors at the end of that fund life. So that's one option to invest in. It's typically more locked up over that time period than the other option, which is an open-ended fund. And an open-ended fund is something that's just, there is no specific term or time frame. You can get into it or get out of it whenever you want, subject to the queue or the lineup of investors getting in there. In some cases, it could take a couple years, sometimes a couple months to get in there. But because these investments are much slower to be traded, selling shares of Microsoft is very fast to do. You can just go online and type in sell and it's going to sell. Selling a building or a wind farm or a solar farm is a much longer process to do something like that. So that's why it would take a lot longer to get your money out and to get your money invested as well. So for the open-ended fund, there is no specific lifetime. You invest, maybe it takes a year to get your money in, but you can stay in there as long as you want. 5 years or 20 years later, you could say, okay, I'm ready to take my investment back or half of it back, whatever the case is. And again, subject to the redemption policy, which could say, you need to give a 3-month notice period to get your money out, whatever the case is, you'd be able to, whereas the closed-ended it's a specific 10-year life, and then you're getting your money back whether you want it or not. So some of the different types of alternative investments, so mortgages would be an example, and in a lot of ways, mortgages are very similar to bonds in that you're lending money to somebody who's using it. In this case, they're using it to finance or to purchase a real estate asset, a building, but you're getting your regular income or regular interest payments, and sometimes it might be interest only, or it might be a combination of interest and principal. And typically we're looking at mortgages in the commercial space. So this would not be single-family homes in Vancouver or Toronto or anything like that. These would be things like warehouses or big apartments where it's the entire apartment building, not just individual units, or grocery stores, banks, things like that. And these are a good investment. Typically you'd be earning somewhere between, call it 1 to 3% above what you'd be getting from bonds. So there's a good premium that you're getting investing in mortgages instead of bonds. And there's recourse or collateral. If the borrower is not able to repay, then you would have a claim on the building that they use the mortgage for. Real estate, so same idea, except instead of lending money, here you're actually owning the building. So whether it's an office building, office is a sector that's been hit pretty hard since the pandemic, but there'd be examples of office buildings in portfolios or industrial warehouses, things like that. And here you're actually owning the asset, the property itself, not lending money on it. And so you'd be making money as the value of that property would be increasing over time. You could also be earning a regular income payment through the rents that the tenants are paying there. So a few different ways to make money on the real estate investments. A couple others would be infrastructure. So this is an asset class that we really like for investors who can manage the illiquidity because these are really strong, stable investments that are generally protected from what's happening in the economy or what's happening in the stock market. These are long life, so a lot of these might be 30 to 50 year projects, so a very long time horizon. Capital intensive, so it's hard for somebody else. You know, it's not like Aunt Susie's beach shop where somebody else can just open up a stand right beside her. It's very difficult to get into this space, and so that's good for investing in there. You don't have to worry about competitors coming in and undercutting you or things like that. So it's very good that there are high barriers to entry in this space. Two broad types of infrastructure. One would be economic, so things like toll roads or airports or other like seaports, electricity transmission, and so these would be assets where there is some correlation tied to the economy. In some cases, the revenue that you'd get as an investor would just be based on availability. So if you're making a toll road, or the investment manager is maintaining the toll road, as long as cars can drive on it, you'd be getting paid from the Crown Corporation or state government, wherever it is. But sometimes it would actually be linked to what the tolls are. And this could apply for airports as well, where the revenue that you generate is based on the traffic. So it could be quite a different risk profile there. But with the economic types of infrastructure, there generally is some relation to how the economy is doing, maybe some link to inflation, whereas social infrastructure would be things like hospitals or courthouses or universities, things like that, where you're just, the investment manager, somebody would build a hospital. All they've got to do is keep the lights on for the next 30 years, make sure the doctors and the nurses and everybody can use it, and they're going to earn maybe a 7 or 8% return from the provincial government. So very steady. Social infrastructure would generally be less risk than the economic infrastructure. A few other ways of breaking down the infrastructure space. So contracted revenues. So typically these would be a government counterparty, where social infrastructure would be contracted, where you've got an agreement, you're going to maintain the hospital or the courthouse for the next 30 years, and maybe you could get a 7 or 8% return, something like that, where others could be GDP, like explicitly GDP linked, where the revenue is tied to inflation. So maybe for a toll road, the tolls that would go up every year are tied to inflation, something like that. A couple other categories, so private equity, so very similar to the public equity, except in this case you're owning a private business, not something that's publicly traded. So same idea, you'd be earning money as the value of that company would increase. There's different risk spectrum within private equity. Venture capital is typically a higher risk, but you'd expect to earn more return, and that's new businesses that are starting out. So a lot of the time these businesses are not going to be successful, and investors could lose their money. But the few times where they are successful, they might earn 5 or 10 times what they've put in. So a higher risk return spectrum for venture capital. Whereas buyout, these are companies that have been around for a while, and so there's still absolutely risk there, but not as much risk as a new company that's just being formed. Private debt, same idea as the bonds. You're lending to an organization. Here, a company, they might be borrowing money for maybe an acquisition, or they've got a new product, or for whatever reason they need to spend more money. They could look to the private market to borrow as well. So there's a big, and since 2008 actually, there's a lot more opportunity in this space because what used to be dominated by the banks, regulations have impacted their ability to lend in this space. And so we're seeing a lot more activity in the private lending or direct lending or private debt space. But again, similar to bonds in that you're lending. One key difference with private debt versus traditional bonds is that a lot of the loans here are floating rate. And so when interest rates move up or down, a Government of Canada bond, it's still going to be that fixed cash flow stream that you agreed to at the beginning. But for these private debt loans, a lot of them, the interest that you'd be collecting as an investor would be going up as interest rates increase. So a good diversifier in that sense. So investment monitoring. So this is one that Suzanne touched on earlier. And the idea here is how do you see how the managers are doing? How is your overall fund doing? And so, typically, certainly where we're involved as an investment consultant, we would provide that service. So we would look at the overall fund, how the underlying managers are doing, making sure that things are compliant with the investment policy. So, if you're specifying certain credit ratings or the assets have to stay within this allowable range, making sure that the investments are in compliance with the policy, the managers are doing what they say they're doing, looking at performance relative to the benchmarks, making sure those benchmarks are appropriate. So, using the right bond index for the bond strategy you're invested in, things like that. Often this would happen on a quarterly basis. Some cases could be semi-annual or annual, but that would be outlined in the investment policy, the frequency that you're looking at it. Again, the timeline that you're looking, typically, market cycles over 4 and 5 year periods is what the primary objective may be, but you also want to be looking over the short term as well to see if there are any trends or red flags that might require action. And so, different ways of looking at performance relative to the TSX or the U.S. S&P 500. You could also be comparing it on an absolute basis, either like a flat return of 6%, or it could be tied to inflation, so CPI plus 5, something like that. But it's also good to look at how the managers are doing against their peer groups. So, how are global equity managers doing against the other global equity managers, not just against the market index. So there's lots of different ways to look at how the fund and the managers are performing. And then the overall plan benchmark or the trust benchmark or the fund, whatever it is you're looking at, where it would be a combination of all of the underlying benchmarks rolled up to the total fund level. And then manager accountability is another one. So again, part of that investment monitoring process is making sure that you're looking at the performance on a regular basis, comparing against the appropriate objectives, both the market benchmarks and the peer groups. If there's significant outperformance, if you signed up for a low risk strategy and they're providing very high returns, maybe it's great, there's some good reason for it, but maybe they're taking on more risk than what you originally thought you were getting into. Underperformance is probably what would be more common thing to look at is, if they are underperforming relative to either the index or the peer groups, understanding why that is, and maybe there's a good reason for it, but maybe there's not a good reason for it, and you should be looking for another manager or adjusting your asset mix, whatever the case may be there. Organizational changes for a manager, that's another big one to keep an eye on. If the key people leading the strategy are retiring or they've left on short notice or something like that, it's very important to have a discussion on succession planning, and that could be a reason to move from one investment manager to another, is that the key people who are involved are no longer there, and you don't have the confidence in the new team. More often than not, they would have succession planning, and often retirements are announced well ahead of time, but that's not always the case. And just understanding their investment process and strategy. So when you're hiring an investment manager, it's really important to understand, what is their philosophy? What is their process? How do they decide what companies to buy or sell or real estate investments, whatever the case is? And just making sure that they're staying consistent with that approach. They're not trying to catch whatever the latest trend is and falling behind on something like that. Compliance statements or compliance letters would be another important thing to look at, where managers, every quarter, however frequent it is, are providing some assurance that they are staying in compliance with either their own or your investment policy, or both. So that was it for the bulk of the presentation. We do have a group.